Kotak AMC joins us on the show right now. Harsha, hi, morning. Some of your peers seem to believe that the upside for the markets this year is capped for the Nifty around 11,000, citing many India-specific risks like twin deficits, rising oil, inflation, interest rate, LTCG, political uncertainties. Would you also believe the same, that these macro parameters are going to hamper the Nifty growth?
Without getting into specifics on index targets, our belief is also that this year is going to be a year of consolidation after a stupendous rally that we saw in the year 2017. And also last year the volatility was very, very low, not just for Indian equities, but across the globe for equities. I think that situation has already changed, and we believe that this year it's not going to be a one-way street anyways. And also the returns expectations from investors will have to be more moderate.
What should be return expectations for this year? Because we're already down 10% on the index, 15% for an average fund, 20% plus if you bought into mid and small cap stocks.
Nikunj, if you look at earnings expectations, even today the Bloomberg consensus expectations for financial year 19 is somewhere around 20 to 23% for financial year 19, which we think is difficult to achieve. So it will go down to maybe somewhere in the mid-teens. So to that extent, some of the correction that we have seen is fine, and from here on I think market should broadly move in line with earnings growth. Having said that, we are also in a pre-election year. I think second half of this financial year, the market may be driven more by sentiments rather than just numbers. So to that extent, one has to remember that it may not be a easy market to invest into.
Harsha, so if one has to look at the construct of what really could be the news flow and where do you think there is scope for earnings recovery, let's talk about the banking sector. Now first there was the PNB scam, now there is fear of rising bond yields and what that could do to portfolio. The credit offtake has also not taken off. So at a time when the banking sector is dealing with real pressures, how does one judge the economic activity and the economic growth for this financial year?
See, clearly that's the reason why we also believe that the 20 to 23% earnings growth expectations may not be met. I think banking sector alone can derail that expectation. And earlier there were concerns about only unraveling of the fraud at one of the PSU banks and its impact on the overall system. But clearly I think after having seen Feb 12th circular from RBI, which also means that there will be acceleration in terms of recognition of NPAs, because earlier there used to be some hiding space at least as long as the restructuring process was on. Currently that leeway is not going to be there. So clearly the numbers in terms of provisioning for banking sector will continue to remain quite high even this financial year. And that's it. That is what is going to bring down overall earnings expectations. Having said this, we are seeing a good amount of economic activity, especially seen through some of the high frequency numbers which come on a monthly basis. You look at the aviation passenger traffic, the two-wheeler sales, four-wheeler sales, CV sales, cement sales. So many of these numbers are clearly showing that there is inherent demand in the economy, and only thing is it's not across the board. You will have to remain in pockets where earnings growth is likely to be more stable than the overall market, and see whether that is available at reasonable valuations.
Harsha, I have a twofold question for you. I know we are not supposed to get into stock specific, but given mandatory disclosure of your portfolio, you have about a 4.5% exposure to ICICI Bank, and this is really on account of viewers tuning in. Some of them would be investors in your funds. What do you make of the controversy that's marring ICICI Bank? There's also Axis Bank, which has been brought into the same fold. And how, as Mr. Vijay Kedia put it yesterday, the banking sector is facing an identity crisis. For a fund manager, it's not just about a particular bank or two, it's also about the sector as a whole, because a lot of mutual funds have a large weightage to the space.
Very true. I think it's definitely concerning to us as well. I mean, earlier the issues were only pertaining to public sector banks. Now we have seen a couple of private sector banks getting dragged into some of the controversies. We really don't know how finally these things will sort out themselves. So to that extent, within the banking sector, the options are becoming very, very limited in terms of where you can invest without fear. As it is, we had a significant proportion of our banking sector weight into some of the retail private sector banks, so that continues. And also we had reasonably large weight into insurance companies, which are also part of the banking and financial sector as such. So between these two, we believe that our banking sector exposure is largely stable. And as and when we hear more in terms of the developments, we will monitor our portfolio and take actions or corrective actions as necessary.
And just to follow up then, you know, as an extension, how are you placing your investments in the construction space, the steel sector, the commodity sector, essentially where the banks have lent and where, you know, there are question marks about repayment capabilities for a lot of the businesses. I'm not saying that you have exposure to them. I'm sure, you know, you did your due diligence before investing in those businesses. But how do you see the outlook for the construction side for the high debted sectors so far?
Even before the concerns on interest rate increases came into market expectations, we were of the view that as long as we bet on some of the financially strong construction companies or non-leveraged construction companies and cement companies and engineering capital goods companies, we should be okay in terms of overall portfolio construction. That was our idea, and we continue to hold that view. As far as steel sector is concerned, we don't have any equity exposure to any of the NCLT cases as such. And even within steel, we believe the long side is more linked to construction activity than the flat steel. So our position is largely in long steel industry.
Harsha, I have to, you know, revisit some of the favorite stories in the market, and that clearly has been the construction theme. You know, if I map the daily pattern on some of these stocks, be it the NCCs, the HCCs, or the NBCCs of the world, that's where all the traction has been, or for that matter, some of the road companies in specific. What with the market coming off 10%, but names like Dilip Bilkon, for instance, already notching 52-week highs on a daily basis. Do you think this is the theme where if one sticks by, it's bound to be profitable even now?
I think so, because earlier it was just on order inflows that some of these stocks were moving up, but we have clearly seen execution pace picking up across the board in this sector, and that augurs well for all the road construction players as well as all the other allied industries which are linked to road construction. And I think while the first leg of outperformance may have already come in, but I think even now we believe that as long as the execution pace is going to remain high and further orders are likely to come by, I think this is a good place to really invest into.
Soon we're going to be hitting earnings as well, Harsha, and the other hiding pocket in the volatility of February as well as March has surely been IT. But do you sense within IT, while it may be predictably a muted quarter, we may see some of the mid-cap companies perform better because they will have a better cross-currency tailwind attached to them?
See, largely the commentary from large IT players has been neutral. I don't think anybody has given any positive guidance as such, but I think as you rightly said, it has become a hiding space. And even this quarter, while the expectations are not very high, I think it can remain one of those areas where the volatility is going to be a lot lesser. But I really cannot say the same for mid-cap IT. We have already seen a couple of other IT mid-cap companies coming out with warnings. That's a sector where there will be volatility. I don't think it's a homogeneous sector, so you can't really take a bet on the entire mid-cap space as such. You will have to be stock specific. But overall, I think no news has been good news for IT sector. So as long as there is no news, I think given the way the market construct is, this sector is likely to remain quite steady.
Go back to this entire banking question which Tanveer asked you, and the reason why I'm revisiting banking is because most of the, I wouldn't say most, but I would say with the exception of one or two, all major mutual funds currently have a overweight position in private banks. You know, we earlier thought that private banks could do no wrong. PSU banks were run by crooks, private banks were run by saints, but that may not be the reality. Axis Bank and ICICI Bank, they've had the challenges, not operationally, but in terms of the book quality and the kind of disclosure they've maintained. So what is the way forward for financials now? You will not buy PSU banks because there are governance challenges. Private banks again are suffering with NPL issues. The P multiples or the price to book what some of the private banks have commanded, that has also started contracting. So how would you bet on financials then?
Nikunj, we always classified banking into two segments. One, private sector retail, which doesn't have legacy NPA issues, and also from a corporate governance perspective, until now almost all of these banks have had an easy phase. The other pocket is PSU banks. I think uniformly they have lesser capital at hand and also have more issues on the NPA side. And similarly, some of the private sector banks which have large exposure to corporate credit have also been somewhat questionable in terms of the NPA treatment and also how the numbers are going to pan out in the near term. So to that extent, I would club the corporate lenders within the private sector as well as PSUs at one segment, and the other pocket is obviously the retail financials, including some of the private NBFCs, which have reasonably large exposure to retail side of the business. And that, along with insurance, happens to be our core portfolio within the banking as of now, and will likely remain the same even going forward.